Hi, I'm Susan Dziubinski with Morningstar. Every Monday morning, I sit down with Morningstar Research Services Chief U.S. Market Strategist Dave Sekera to discuss one thing that's on his radar this week, one new piece of Morningstar research, and a few stock picks or pans for the week ahead. So, on your radar this week, Dave, are a few earnings stragglers. Who's on tap that you'll be watching for?
Hey, good morning, Susan. It's interesting. So last week, the focus was really on the industrial sector, and the week before that was on the technology sector. So the focus this week is really all going to be about the U.S. consumer. So we do have both Walmart and Target reporting this week. Now, between those two, I think they provide us really the broadest view of the U.S. consumer. And I know there's three things that our analytical team is going to be listening for, and that's really going to give some indication on consumer strength. So the first one is, are consumers still shifting their spending into grocery and away from goods? Are they also still trading down to private label brands as opposed to kind of the premium branded goods? And how many items are they buying, per trip? We've definitely seen a shift of people buying, fewer items per trip to the store. So if the answer to these is yes, I think that indicates that the consumer is still under pressure. Some of the other retailers that are out this week is Home Depot. I think that's going to give us some indications on what's going on in the housing market. And I know they're going to keep a close eye on the number of transactions as well as the average sales per transaction. So I know what we've been seeing at Home Depot for a while is a trend towards smaller projects, less big ticket items, and that home projects have actually become much more non-discretionary as opposed to remodeling. I would caution investors here, it is a 2-star rated stock, trades at a 27% premium to our fair value. As far as upper end consumers, I know we're going to be looking at Estee Lauder. I think that'll provide us some insights there. Now, Estee Lauder stock has been on a downward trend for a while, but we do think that it's sold off too much. It's a 5-star rated stock, trades at a 34% discount to our fair value. In fact, it was actually recently added to our best ideas list. And our analyst there, she's noted here that the challenges are really cyclical, not structural. She's also highlighted for long-term investors that there's really very good growth prospects here in the emerging markets. I think that's about 1/3 of their overall sales. And then lastly, for the value conscious consumers, we'll be looking at TJX there. And of course, they are a value proposition for, off-priced retail. And that should continue to perform well in this economic environment. However, I think that's already reflected in the stock. That one's a 2-star rated stock, trades at a 22% premium to our fair value.
So now earnings season is, starting to wind down. What percentage of companies have reported so far, and how did things look? Did most companies meet those forecasts?
So I think right now we're probably pretty close to 90%, maybe slightly over 90% of the S&P 500 have reported. And as you and I, we've discussed here in the past, with the economy being stronger than expected in the second quarter, management having provided pretty conservative guidance, coming into this quarter, there's been a higher than average number of companies that have reported earnings well above their consensus.
So what are some of your key takeaways then from this earnings season?
Well, one of the things that's really stood out to me this earning season is the bifurcation we've seen between like the virtual or online world, versus kind of the real world or the in-person world. So in the virtual world, things are still going, very well. We're still seeing very strong earnings growth, good top line growth, good outlooks, stocks like Alphabet, Microsoft, Amazon, Meta, all doing very well. Whereas in the real world, I think things are much more mixed. And we started talking about this, after last quarter, and we're still seeing, those short cycle industrials continuing to show economic weakness. That began last quarter. Companies such as Honeywell and JCI, I think our analytical team has called out, that short cycle weakness there. Now, the long cycle industrials, I talked to Josh the other day. He actually kind of laughed and said, recession? What recession? I mean, not only are the long cycle industrials not being impacted, but he's seeing even stronger backlogs. He also noted that anything tied to infrastructure spending was just in great shape. Eaton was one company that he highlighted there. And I also noted too that engineering and construction companies do have a good tailwind behind them, as well. And then lastly, among the consumer related industrials, there has definitely been some disappointments. The top line has been weaker than expected. A lot of them are struggling to put through, the price increases that they need in order to cover their own inflationary cost increases. 3M would be one that we would highlight there. So net, I would say that, the takeaway here is I do think that what we've seen thus far does support our economic outlook. No recession, but a slowing rate of economic growth for the next couple quarters.
So early in earnings season, stocks did, pretty well, but they seem to be retrenching a bit so far in August. Why do you think that's happening?
Well, and I think this really gets back to kind of the two parts to the earnings season. So the first part of the earnings season, in July, that was all about the virtual world. Many of those stocks we thought were actually still undervalued, coming into earnings. A lot of those companies, beat their numbers. So we did see, those stocks surge after earnings. And then here in August, the second part of earnings season being more focused on the real world has had mixed results. We've seen a number of companies that have missed expectations or gave downward guidance. Those stocks sold off, pretty hard. So from a broad market perspective, we are seeing that consolidated analyst, expectations, consensus earning projections are essentially unchanged. Now, typically, I would expect, during earnings season to see those numbers, start coming up. And I'd also note that a higher percentage than normal of companies have given, slightly negative guidance. It's not that much more negative, but definitely, some negative guidance. And I think the market is just generally kind of disappointed in that. I think the market was hoping for better.
So then what might this all mean for the market for the remainder of the year, Dave?
So from a valuation perspective, following this little bit of a pullback we've had here at the beginning of August, the market right now is trading at a couple percent, discount to our fair value. Now, long-term investors that maintain their allocations, through this should expect to earn, cost of equity over time, kind of like an 8 to 9% area. So again, for long-term investors that have the wherewithal to hold through, any kind of market volatility in the short term, I still think you're in pretty good position. But I do think this is a good time to take another look at your portfolio. Look for those stocks that at this point in time, have become overvalued, overextended. Sell those, lock in your gains, and reinvest in those stocks that are undervalued and have lagged behind, the rest of the market. Now, from a trading perspective, I am a little more concerned that I do think there is some downside risk over the next couple of months. Specifically, we do forecast that third quarter GDP will probably only come in about, 1%. So definitely slowing economic rate of growth. And if we are correct, I do think the risk here is to the downside, in the short term. However, for most investors, time in the market is more important than trying to time the market. So on the other hand, sounding like an economist here, so while it's not our base case, the economy could once again, hold up better than expected in the third quarter, kind of like what we saw in the second quarter. So for example, again, it's still very early in the third quarter, but the Atlanta Fed GDP now, which is a metric which is based on economic metrics, as they come out, that's still 4.1%. So if the economy were to hold up, this well in this quarter, there is still room for the upside.
So let's pivot and talk about some new research from Morningstar, some updates from our analysts on stocks that they have differentiated opinions about that reported last week. And I think the biggie here is probably International Flavors and Fragrances.
Mm-hmm.
It's a stock we've talked about before on the show, but earnings disappointed, the stock plunged, and Morningstar even cut its fair value estimate on the stock. So let's walk through what happened and what we think of the stock today.
Yeah, and there's no way to sugarcoat this one. I mean, it was definitely a disappointing quarter, but I do think, for long-term investors, you need to dig deeper into the specifics of the results. So I did look through our analytical research here, and one thing that Seth Goldstein noted was that there's a significant difference in the company's performance, between its specialty ingredients versus its commodity-oriented ingredients. Now, on the specialty side, I think that's about 3/4 of their sales actually did okay. I mean, they even saw an improvement in the margin. They were able to put through, some price increases faster than inflation. So that part of their business worked out pretty well. However, the commodity ingredients, I mean, the volume there fell 20% and really pushed down, the margins in that side of the business. So I know he did update his model. He did reduce his forecast for the commodity ingredients, pulled that down by 20% for this year. And then he's only looking for modest growth thereafter. So the other part was the projections for the specialty business. And based on this quarter, he left his outlook there unchanged. So we do forecast that, if IFF will be able to continue to raise their prices enough in order to be able to recover that cost inflation that they've given up, the past couple of quarters and get back to historical norms, the company overall still looks good from a long-term perspective. Now, as you noted, we did cut our fair value by 7%. However, the stock fell about 20%, in the market. And I think the stock market movement here is an indication not just of, concern about the near-term fundamentals, But I think this is a case where investors do seem to be losing their confidence, in management. The company's now reduced guidance, 3 times over the past 3 quarters. So at this point, it is a 5-star rated stock, trades at about half of our fair value. And then just as a takeaway here to give you an indication of where it's trading in the market, looks like it's trading at about 18 times our 2023 earnings estimate. But when you look at earnings for 2024, it's a much more modest 14 times.
So another stock that Morningstar has liked, but that disappointed last week was Tyson Foods.
Mm-hmm.
Here, however, we stuck by our $85 fair value estimate.
Yeah, and it's another one too where I think it's good to take a look at the market reaction, and how that stock traded. So initially it dropped pretty hard at the open, but by the end of the trading day it was down less than 4%, and it's actually continued to keep recovering a little bit since then. And this is just an indication that I think the market was initially very focused on just continuing weak profitability there and had overlooked some of the sequential improvements that it had, quarter to quarter. So I noted here, our analyst report, he said that, there's really no structural change here that altered his long-term outlook. Overall, we're still looking for, low single-digit, percent revenue growth and the company return back to kind of that mid to high single-digit operating margin range. As such, that puts our fair value at 5 stars. It's a 35% discount.
And then lastly, we have Eli Lilly. Lilly reported really strong results with a lot of excitement last week around its weight loss drug Mounjaro. But we maintained our fair value estimate, and we think the stock is pretty significantly overvalued. Talk about that one.
Yeah, I mean, that stock popped 15%, and that's really a big move for a pharmaceutical company. I mean, rarely do you see those kind of, movements there. And I think this is a case where investors are just paying up too much for the short-term growth. In fact, our equity analyst, Dave Sekera, he noted that in our model, we already have an above consensus projection for peak sales for the diabetes and the weight loss drugs here. Yet that stock is now rated 2 stars and trades at a hefty 44% premium to our fair value.
So now it's time to move on to the picks portion of our program. And this week, Dave, you're focusing on 4 stocks to buy after earnings. Your first pick this week is Jacobs Solutions. We've talked a little bit about this stock last week before earnings. So how did earnings look and why do you like the stock after?
Yeah, so earnings, overall were in line with our expectations, and management also reiterated their fiscal year 23 earnings outlook. And I think we're going to see some good positive fundamental momentum at this company, and not only carrying into, the latter half of this year, but actually over the next couple of years into 2024 and 2025. I do think that they're going to be a beneficiary of the infrastructure spending coming from the Inflation Reduction Act. And the market definitely liked what it heard, this past week. The stock was up 7% on the week, and we still think it's undervalued. It's a 4-star rated stock, and it trades at a 13% discount.
So your next stock of the week is a name that actually spent a good deal of time in overvalued territory, but it's now quite the opposite. It's American Tower.
Yeah, I mean, for years, the cell phone tower REITs all traded, kind of in that 2-star, even at that 1-star level. We could never figure out back then why the market was placing, such a high valuation on them as they had. Those stocks did start to come down in 2022. That downward momentum is carried into 2023. But to us, it appears the stock has fallen enough that it looks like it's now starting to bottom out. Now, they did beat consensus both for revenue as well as earnings here for the second quarter. And in fact, they raised their guidance for both the top and the bottom line. It's a company that we do assign a narrow economic moat. It's rated 4 stars, trades at an 18% discount, and pays a 3.3% dividend yield.
Now, your next stock of the week is from the tech sector, which, we've talked about has done quite well this year. And in general, that sector is overvalued. But of course, there are opportunities within it. The stock is Cognizant Technologies.
Yeah, and it's one of those ones where maybe people aren't necessarily that familiar. So it's definitely good to do some research here. But Cognizant is a global IT services company. They provide consulting and outsourcing. So this past quarter, they beat earnings, raised guidance. The stock was up 7%. And this one, I really like the story here and talked to our analyst on this one. And she noted that, they're not just going to be a beneficiary of the long-term digital transformation trends, but also beneficiary from artificial intelligence. So this is a company that we do have a narrow economic moat that we've assigned to it. It's 4-star rated, trades at a 25% discount, and pays almost a 2% dividend yield.
And then your last stock pick this week ties to a theme that we've talked about before, MedTech. The pick is Guardant Health.
Yeah, so Guardant provides a number of different cancer and blood tests. They are waiting on FDA approval for a colorectal cancer detection test. Now, in mid May, we did publish an article that outlines why we think that liquid biopsies really could usher in a paradigm shift in cancer detection. We do think that that's an area of the market in medtech specifically that could grow exponentially over time. And Guardant was one of the two stocks that we highlighted in that article. They posted pretty strong second quarter results. They raised their full year guidance. Now, we maintained our fair value at $63 a share. Now, I will caution it is a no economic moat rated stock, but at a 42% discount with a 4-star rating, I think you're getting well paid here for this situation.
Well, thanks for your time this morning,
Mhm.
Dave. Dave and I will be back next Monday live at 9 a.m. Eastern, 8 a.m. Central. In the meantime, like this video and subscribe to Morningstar's channel, and have a great week.